Look at the sheer physical scale of the artificial intelligence boom. By late 2026, these endless rows of data centers are practically humming with the computation required to power the next generation of tech. And the companies building all this infrastructure, the AI labs and tech firms that have aggressively chosen to stay private for years, are finally preparing to hit the public stock market in a massive landslide of listings. This rush spans far beyond software. We're talking about heavy industry and space exploration. Companies like SpaceX, whose side projects in AI put them firmly at the physical leading edge of this highly anticipated market return. But these highly anticipated companies are bringing something else with them to Wall Street: absolutely otherworldly valuations. When we say valuation in this context, we mean the total price tag investors are willing to place on a company. Right now, the market is attempting to price in decades of flawless future success before these businesses even list a single share. To accurately judge how dangerous it is to buy in at those prices today, we have to strip away the current hype and look at the exact same setup from the year 2000. The sheer thrill of a technological leap makes it remarkably easy to forget that historical market cycles routinely punish even the most successful companies. Step onto the floor of the New York Stock Exchange during the height of the early 2000 dot-com boom, and you'll find a highly frenetic, deeply speculative environment. The era is notorious for its speculative froth, handing massive, questionable price tags to any business with a URL for a name, famously resulting in public companies entirely represented by sock puppets. But focusing on the failed joke companies misses a much more dangerous trap. Real, solid businesses with sound fundamentals were swept up in the exact same frenzy. Take Cisco. They were a massive physical corporate entity with a proven product and deep revenue streams. Rather than running a flashy consumer website, Cisco was the picks and shovels investment of the era. They built the foundational network routers and switches that physically allowed the internet to function. Dismissing the entire bubble as an anomaly of fake companies ignores the historical data. The sharpest lesson from that time lies in what happened to the era's most crucial and successful infrastructure builder. By March of 2000, the internet boom had reached its absolute peak. At the time, the reigning corporate heavyweight of the world was the software giant, Microsoft. This chart tracks the market capitalization, or total market value, of both companies. You can see right here in March 2000, Cisco's valuation climbed so high that it actually overtook Microsoft, making it the single most valuable company on the planet. Cisco kept selling hardware, it continued to operate successfully, and its technology defined the internet. Yet almost immediately after hitting that peak, its stock price collapsed. As the timeline extends across the bottom axis, look at how long that line stays depressed. It took exactly 25 years, 8 months, and 13 days for the stock to finally claw its way back to that March 2000 high in December 2025. Pure operational success provides absolutely zero protection against bad investment math. A great company will still be a terrible stock to own if your initial buy-in price is completely divorced from reality. That specific financial reality brings us straight back to the impending 2026 IPO rush. The AI labs and rocket manufacturers going public today may very well achieve their goals. They are highly likely to become the successful picks and shovels of the next century, operating exactly like Cisco did. But buying into the absolute leading edge of technology is not a guaranteed path to profit, especially if the entry price mathematically assumes decades of flawless execution. A business can physically build the future, win its sector, and still cause its initial investors to lose money for decades. If you buy the future at the wrong valuation, you guarantee yourself one outcome: waiting a quarter of a century just to break even.